Hey everyone, I'm John Wiswell, and welcome to Beyond the Ticker. Before we get started, what you're seeing is an AI-generated avatar. The ideas, the research, the perspective, all real. We just think this is a pretty cool way to bring it to you. This channel is all about pulling back the curtain on how investing actually works beyond the sound bites you might hear, the concepts, the history, the strategies that matter. And today we're starting with something that doesn't get nearly enough attention. Why market crashes don't hurt everyone the same way, and why retirees, specifically, are the most vulnerable when markets fall apart. Let's get into it. Let's start with a simple scenario. Two people both lose 30% in a market crash. Person A is 35 years old, still working, still contributing to their portfolio every month. That 30% loss hurts, but they have time. The market recovers. They recover with it. They might not even feel it 10 years from now. Person B is 67. Retired last year, not adding to the portfolio anymore. They're withdrawing from it every month to cover living expenses. That same 30% loss doesn't just hurt, it can permanently alter the course of their retirement. Same crash, two completely different outcomes. Why? It comes down to something called sequence of returns risk. And this is one of the most underappreciated concepts in personal finance. Here's the idea. The order in which you experience investment returns matters just as much as the returns themselves, especially the moment you start taking money out. Say the market drops 30% in your first year of retirement. You're now withdrawing from a smaller pool. That lost money never gets the chance to recover. Every withdrawal going forward comes from a base that's already been damaged. And that compounds, in the wrong direction, over time. Excited, you can probably imagine in your head how this works out in the long run for the investor who did not have to live off of their investments. A younger investor in the same crash is still contributing. They're buying more shares at lower prices. Time is working for them. If the younger investor stays consistent, the 30% correction that eventually recovered actually helped them down the road. For a retiree, time is the one thing in short supply. And this isn't hypothetical. We've seen significant downturns in 2000, 2002, 2008, 2022. Anyone who retired just before those events felt this in a real way. Now, the traditional response to this problem has always been move into bonds as you get older. Reduce your stock exposure. Play it safe. There's logic to that. Bonds generate income. They're more stable than stocks. But that approach comes with its own trade-off. You may be giving up meaningful growth in exchange for that stability. And in a world where people are living well into their 80s and 90s, a portfolio that's too conservative can quietly run out of steam long before you do. So retirees often find themselves caught between two risks. Stay too aggressive, and a crash could devastate them. Play it too safe, and they risk outliving their money anyway. That tension right there is what we're going to keep coming back to on this channel. Because the investing world has evolved, and there are ways to think about this problem that go well beyond the traditional stocks versus bonds conversation. Over the coming videos, we're going to dig into how markets have behaved historically, what it actually means to protect a portfolio, and how investors have started approaching retirement risk in a fundamentally different way. We're just getting started, but I want you to walk away today understanding one thing. The biggest threat to a retiree's financial future isn't always a bad market. Sometimes it's a good market that turns bad at exactly the wrong time. Now, knowing this risk exists is only half the battle. The other half is doing something about it, and that's exactly where we're headed. In the coming videos, we're going to explore what protecting yourself against sequence of returns risk can actually look like. I think it'll give you a new perspective on retirement investing. If this resonated with you, subscribe to Beyond the Ticker. And if you know someone who's approaching retirement, share this with them. Understanding this before you get there makes all the difference. I'll see you in the next one.